Welcome back. Now, China has met its official growth target, posting 5% GDP growth in 2025. But beneath the headline number, signs of strain are emerging. Growth slowed in the final quarter, consumer demand remains subdued, and the property sector continues to weigh heavily on the economy. Tian Pan, head of strategy at Prescient China, joins us now for a look into China's economic direction and what risks lie ahead as Beijing looks to 2026. Tian, thanks so much for your time. Let's get your reading on that print. As I highlighted there, growth hitting that 5% goal for the year period. But when looking at Q3 against Q4, we did see growth slowing.
Yeah, actually, it's been the trend for the entire 2025. So we started off with a great quarter, and then it's just was gradual slowing for the remaining of the year, and then ending up with 5%. I think overall, nothing out of the ordinary, nothing amazing, but given that it has been a year that was dominated by the Trump-related global tariffs that also heavily impacted China, I think the economy did quite okay under the circumstances.
And talking about those tariffs and relations with the U.S., it's really interesting to see that exports remained strong. Yes, exports to the U.S. continue to decline, but we did see China diversify away from the U.S. and really pivot into other markets. Just your analysis on, China's economy still being driven by exports and how they've managed to sort of weather those tariffs.
Yeah, so, bilateral trade between China and the US pretty much dropping almost 30%, both imports and exports for 2025. A lot of that made up by additional trade with the rest of the world from China. And obviously, we expect a significant number of exports going to other countries, then a lot of it transshipped into the US again. Overall, China's economy is still very much depending on exports. Probably some of the biggest contribution to GDP from exports in quite a few decades for 2025. And probably not the healthiest development, but I think policymakers here are pretty well aware of it. And there is this sort of aim at transitioning out of exports-driven economy.
And I'll get into some of the attempts by the People's Bank of China when it comes to stimulus. But the last time I spoke to you, Tian, you said that things are good on the ground despite the concerns over consumer spending. Now, slow consumption rearing its head yet again in the growth figures. What's the actual problem here? Are people just being cautious and not spending their money on the back of the property downturn?
Yeah, so you are absolutely right there. The property downturn, so the persistent property downturn that we have expected for years and still expect for years to come actually has had a major and pretty consistent negative impact on household wealth. So that's been the negative consistent factor on consumer spending. I think we would have all seen that the high youth unemployment numbers and overall wage growth has really stagnated and inflation has also really stagnated. Overall, consumers on the ground have been sort of not confident. Last year, there were a lot of government subsidies for consumption that really helped in the earlier parts of the year. And we clearly saw that in the last quarter, when those subsidy quotas ran out, we saw a decline in growing consumption. So it remains a very challenging task ahead to find that consistent growth in consumption rather than temporary increases by handing out cash.
And I'm wondering how then the People's Bank of China tries to, balance out stimulus, especially when it comes to stimulus targeted at consumption and stimulus targeted at investment.
Yeah, so I think China as an economy, as a consumption economy, is quite different to what we're used to in the West, for example, quite different to America. Whereas in America, if you lowered interest rates, there would naturally be quite a lot more borrowing, at least on a relative basis compared to China. In China, you can lower interest rates, but typically people do not have more demand for debt if they don't have expectation of better or consistent future income. And that's a bit of an issue from the central bank side, a different problem. compared to what Western central banks would have. And that's probably what we are facing in China right now.
Now, with that issue, those risks still persistent, that being the bilateral relations with the U.S. as well as downbeat domestic demand. What is your outlook as we enter 2026? Will we still hit those 5% levels? Are we going to see even better growth this year?
So the official target remains for 2026 around a 5% GDP growth target. And given the Chinese policymakers' track record, we expect that number to be reached. So around 5% may be the region of between 4.5 to 5.5. So overall, the outlook would still be fairly consistent compared to 2025. In terms of external shocks, like you mentioned, the bilateral relations with the US, we actually expect a significant improvement compared to 2025. So we expect up to 4 potential in-person meetings between Chinese President Xi Jinping and US President Donald Trump. And with those meetings, we actually expect positive developments given all the positive developments in bilateral relations in the last quarter. We saw the Canadian Prime Minister just visited China, signed a lot of agreements, quite positive. We expect the UK Prime Minister to visit later January, and the German Chancellor to also visit in February. So all of these high-profile global bilateral meetings should generate a lot of positive policy and agreements internationally, and we see those as all positive drivers for the economy in China and probably globally for 2026.
Quickly before I let you go, there is an issue around the AI race between the US and China. Your thoughts on that just after TSMC Taiwan signed that deal with the US?
Yeah, so AI, China and the US by far leading everybody else, both in terms of hardware and in terms of software. In terms of hardware, China really catching up with Huawei and companies, local champions like Capricorn, to the likes of NVIDIA. We saw in December that NVIDIA actually gained approval to sell probably its second most powerful chipset, the H200 series, to China. We've seen comments coming from US AI experts to say China or Chinese models, AI models, are now only 6 to 12 months behind those of the US. So competition remains fierce, and I think opportunities in the sector remain. A lot of the valuations are really overstated in our view. We continue to dissect the sector, at least in China's perspective, but we expect the competition to continue, and probably healthier competition going forward than what we have seen over the past couple of years. All
right, Tian, let's leave it there. Thank you so much for your time and taking us through that China GDP print and the outlook moving forward. That was Tian Pan, Head of Strategy at Prescient China.